The arsenal of the master speculator, there is no weapon more powerful, and yet more misunderstood, than the initial commitment. For the amateur, the first trade is an act of total unbridled aggression. He is a plunger, a man who, having formed his opinion, rushes into the market with his entire stake, a single, heroic, all-or-nothing bet. He maximizes his risk at the precise moment of maximum uncertainty, leaving his entire campaign vulnerable to the slightest adverse fluctuation. Jesse Livermore knew and understood that a great campaign is not won with a single reckless charge, but with a cautious, intelligent, and methodical advance. The first step of this advance, the safest mathematical way to begin every winning trade, was his secret of the 1% probe. This was not merely a trading tactic. It was a profound philosophy of risk management, a principle designed to transform speculation from a game of chance into a business of probabilities. The probe was his scout, his reconnaissance mission, a small exploratory commitment sent out into the uncertain territory of the market. Its purpose was not to make a great fortune, but to gather invaluable intelligence at the lowest possible cost. It was his way of asking the market a single critical question before he ever committed his main force. Am I right, and is the time right now? The market's answer to this small initial question determined the fate of the entire campaign. To understand the genius of the probe is to understand the very essence of professional speculation. It is to move from the world of the 90% who lose, a world governed by hope and greed, into the world of the 10% who win, a world governed by patience, discipline, and cold, hard mathematics. It is the art of demanding that the market prove you right before you make your big bet. It is the foundational step that ensures that when you win big, and when you are wrong in a small and utterly insignificant way. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. For those who are committed to this journey of knowledge, who return to these lessons to sharpen their minds after the inevitable setbacks of the market, your support is the fuel that keeps this channel going. The fatal flaw of the amateur is that he believes his analysis, his opinion, is enough. He convinces himself that a stock must go up, and so he buys his entire intended line at a single price. He has given himself no room to be wrong, no way to test the market's immediate reaction. Livermore, in contrast, operated on a principle of profound humility before the tape. His own opinion, however well researched, was merely a hypothesis. The final deciding vote always belonged to the market itself. The probe was his method for calling that vote. He would never begin a campaign by buying his full intended line. He stated it as a core principle. Suppose a man's line is 500 shares of stock. I say that he ought not to buy it all at once, not if he is speculating. Instead, he would begin with a fraction of that amount, a small probe of perhaps 100 shares. This was not a timid act. It was a supremely confident one. It was the confidence of a man who knows he does not need to guess, because he has a system for getting the market to reveal its own intentions. This initial probe was always made at a critical, predetermined price level, a pivotal point. This was the moment he had identified through his patient study as the inception of a potential major move. But even then, he did not trust his analysis alone. He demanded a practical, real-world confirmation. The performance of this small initial probe was the market's final answer. If it showed an immediate profit, his judgment was confirmed. If it showed an immediate loss, his timing was proven wrong, and the entire campaign was aborted before it had a chance to inflict any real damage. This is the mathematical beauty of the 1% probe. The risk is surgically and precisely contained to a tiny fraction of the speculator's capital. It is a small, calculated expense for invaluable information. It is the ultimate expression of his most foundational rule. Cut your losses quickly. The small loss on a failed probe is the smallest and best loss a trader can ever take, for it prevents the catastrophic loss that so often results from an ill-timed, full-sized commitment. Now, Livermore was a master at seeing the effect of market forces, the immediate profit or loss on his probe. But to understand the deep underlying cause of these movements, we can turn to one of his great contemporaries, Richard Wyckoff. While Livermore was the supreme practitioner, the intuitive genius of the tape, Wyckoff was the master analyst. He codified the science of accumulation and distribution, the great campaigns by smart money that create the very trends Livermore was probing. Wyckoff shows you the engine room. Livermore shows you how to pilot the ship. To truly understand the internal mechanics of the market, the logic of supply and demand that makes a probe succeed or fail, we invite you to subscribe to our new channel, Richard Wyckoff Trading Methods. The link is in the description below. The probe, then, is more than just a risk management tool. It is a profound diagnostic instrument. It is the speculator's stethoscope placed against the heart of the market to test its vitality. The immediate profit is the sign of a strong, healthy pulse, an indication that the buying power is real and the advance is sound. The immediate loss is the sign of a weak, irregular pulse, a warning of some unseen sickness, some hidden source of resistance that makes the advance unsustainable. To operate in this way is to transform speculation from a game of brute force into a game of finesse. The amateur tries to batter down the market's door with a single mighty blow. The professional gently tests the lock. If it turns with ease, he knows the door is open and he may proceed with confidence. If it resists, he does not waste his strength. He withdraws and waits for a more opportune moment. This is the great, simple, and timeless secret. The safest mathematical way to start every winning trade is to not start with a winning trade at all. It is to start with a question, a small, low-risk probe that asks the market for its permission to proceed. It is the discipline of demanding that the market prove you right from the start, before you ever commit your real capital. It is the first and most important step in the journey from hopeful gambler to professional scientific speculator. The speculator who has sent out his 1% probe now stands at the great fork in the road. He has asked his question, and the market, in its impersonal and infallible wisdom, is about to deliver its verdict. There are only two possible answers, and the professional's entire career is built upon his discipline to act, without hesitation or emotion, on whichever answer is given. This is the moment where the science of speculation is put into practice, where the amateur is separated from the master by a simple but profound difference in their reaction to the market's immediate judgment. The first possible answer is the one the speculator's ego dreads, but his capital account should welcome. It is the answer of an immediate loss. The probe, his small exploratory position, moves against him. The stock, which should have advanced with vigor from its pivotal point, instead falters and declines. To the 90%, this is a moment for hope, for denial, for the patient waiting that so often masquerades as discipline. To the 10%, to the student of Livermore, this is an immediate and absolute command. Retreat. An immediate loss on a probe is not a failure. It is invaluable and cheaply bought information. It is the market telling you in the clearest possible language that your timing is flawed. It is a sign that there is unseen resistance, that the great underlying forces are not yet aligned for the advance you anticipated. Livermore stated it as a fundamental truth. Suppose he buys his first 100, and that promptly shows him a loss. Why should he go to work and get more stock? He ought to see at once that he is in wrong, at least temporarily. The professional's reaction is swift, mechanical, and ruthless. He closes the trade. He accepts the small, predetermined loss on his 1% probe without a second thought. He does not hope for a reversal. He does not wait for a reason. He does not give the small loss the time it needs to grow into a catastrophic one. He has paid a tiny fee for the priceless knowledge that he is wrong, and he immediately returns to a position of cash, his capital preserved, his mind clear, ready to wait for the next more opportune moment. This is the very essence of his most foundational rule. Cut your losses quickly. The probe is the mechanism that makes this rule easy to follow, for the loss is, by design, always insignificant. It is an act of supreme business prudence. The trader who cannot take a small loss on a small probe will never survive long enough to make a great fortune. He is a man who, having discovered a small leak in the hull of his ship, decides to wait and see if it gets bigger. Now consider the second and far more promising answer from the market. The 1% probe is successful. The stock, having breached its pivotal point, moves decisively in the speculator's favor. It shows a quick and immediate profit. To the amateur, this is often a moment of fear, a nervous impulse to snatch the small gain before it can vanish. But to the professional, this is the only confirmation that truly matters. It is the market's own unambiguous green light, the signal that his entire analytical process was correct, and that a great and profitable campaign may now begin. Livermore was absolute on this point. He wrote, "Experience has proved to me that the real money made in speculating has been in commitments in a stock or commodity showing a profit right from the start. The immediate profit on the probe is not a reason to exit the trade. It is the fundamental and non-negotiable reason to stay in it and, as we shall see, to increase it. It is the market's own validation, a tangible monetary proof that the speculator is in perfect harmony with the line of least resistance. This is the great mathematical safety of the probe method. The risk is always defined, always small, and always front-loaded into a single diagnostic question. The potential for a catastrophic loss on the initial entry is entirely eliminated. The amateur who goes all in at the start has 100% of his bet at risk from the very first tick. The professional who begins with a 1% probe never has his main capital at risk. He is, in effect, using a tiny portion of his funds to purchase an insurance policy on his own judgment. This entire process is designed to remove the speculator's greatest enemy, his own ego, from the game. The probe is an act of profound intellectual humility. The speculator is not declaring to the market, "I am right." He is asking with a quiet and professional deference, "Am I right?" The market's answer, given in the pure and incorruptible language of price, is the only answer he will accept. This mental shift from assertion to inquiry is the very essence of the professional mindset. Livermore's own career is a testament to both the wisdom of this rule and the catastrophic cost of violating it. His disastrous campaign in cotton, where he was so certain of his analysis, serves as the ultimate cautionary tale. Consumed by impatience, he did not wait for the market's signal. He did not send out a small probe. He plunged repeatedly with a full line before the market was ready. He was right in his long-term analysis, but disastrously wrong in his timing. His failure to probe, his refusal to wait for the market's confirmation, cost him nearly $200,000 in direct losses and a potential profit of over $1 million. It was a lesson in the immense price of impatience. In stark contrast stands his legendary comeback in Bethlehem Steel in 1915. He was broke, his confidence shattered, and his entire future rested on the outcome of a single trade. The amateur, in such a position, would have made a desperate, all-or-nothing gamble. Livermore did the opposite. He had identified his stock, he had identified his pivotal point, but he waited with an almost inhuman patience for 6 long weeks. When the moment finally arrived, he did not plunge. He entered with a small, cautious probe of 500 shares. That probe was immediately and spectacularly successful. The stock exploded upward, providing him with the market's definitive confirmation that his long and patient analysis had been correct. That small, successful probe, executed with perfect discipline and timing, was the foundation upon which he rebuilt his entire fortune. It was the ultimate proof of the power of his method, the power of patience, the power of confirmation, and the supreme mathematical safety of the 1% probe. Having successfully sent out his probe, having received the market's clear and profitable confirmation that his judgment is sound, The professional speculator now stands at the threshold of a great opportunity. His initial test is passed with flying colors. His risk is managed. His confidence is high, based not on hope, but on the market's own favorable verdict. The great question now becomes, what is the next move? How does one transform this small, successful probe into the great fortune-making line that is the ultimate prize of the speculative game? The answer to this is the science of the aggressive yet disciplined follow-through. The speculator who has sent out his 1% probe and has received the market's favorable verdict now stands at the threshold of a great opportunity. The initial test has been passed. The analysis has been confirmed. The line of least resistance is clear. For the amateur, this small initial profit is the end of the journey, a prize to be snatched quickly before it can vanish. But for the professional, for the student of Livermore, this is not the end. It is the beginning. The successful probe is not the trade itself. It is the key that unlocks the door to the real campaign, the foundation upon which a truly great and profitable position is about to be built. This is the moment that the speculator transitions from a cautious, defensive posture to a confident, aggressive one. Having minimized his risk on the initial entry, his job is now to maximize his profit on the move that is proving to be correct. This is accomplished through the most powerful and yet most counterintuitive of all professional techniques, the science of pyramiding. It is the art of adding to a winning position, of reinforcing success, of building a great line of stock not with one reckless bet, but through a series of disciplined, mathematically sound and market-confirmed steps. The first principle of the pyramid is the polar opposite of the amateur's greatest sin. Where the amateur averages down his losses, the professional averages up his profits. Livermore's rule was absolute. Each succeeding purchase must be at a higher price than the previous one. He would add his second, third, and fourth lots of stock only as the price moved into new high ground, with each new purchase serving as a confirmation of the one that came before it. This is not the act of buying an expensive stock. It is the act of buying a stock that is actively and repeatedly proving its own strength. The logic is unassailable. The initial 1% probe, by showing a profit, has already confirmed that the stock is in a position of strength. To buy more at a higher price is simply to add to that confirmed strength. The speculator is not fighting the trend. He is joining it, his commitment growing only in proportion to the market's own validation of his judgment. He is not acting on hope. He is acting on the irrefutable factual evidence of the ticker tape. This is where the true mathematical genius of the method is revealed. With each new, profitable addition to the pyramid, the speculator's psychological and financial position becomes stronger, not weaker. The accumulated profit from the earlier, lower-priced purchases now acts as a powerful cushion. He is, in a very real sense, letting the market finance his increased exposure. The risk on his second, third, and fourth commitments is mitigated and in some cases entirely covered by the profit he already holds. This method was perfectly exemplified by the system of the great gambler Pat Hearn, a man whose methods Livermore deeply admired. Hearn would buy his first 100 shares. If it went up 1%, he would buy another 100 and another and another. But the true secret was in his risk management. With every new purchase, he would move his stop loss for the entire position to 1 point below the price of his last purchase. This simple mechanical action systematically locked in the profits of his earlier commitments, ensuring that even if the market suddenly reversed, he would be taken out with the vast majority of his winnings intact. The pyramid, then, is not just an aggressive offensive strategy. It is a profoundly intelligent defensive one. It allows the speculator to build a massive line, a line capable of generating a fortune, while at the same time systematically reducing his overall risk. The amateur who goes all in at the start has 100% of his bet at risk from the very first tick. The professional who builds a pyramid has his largest commitment on the books, only when the trade is already a significant winner, his initial capital long since protected by the market's own profitable advance. This, then, is the complete journey of a winning trade, from its inception to its culmination. It begins not with a bang, but with a whisper, a small, cautious 1% probe. It waits for the market's own, clear and profitable confirmation. It then evolves, step by disciplined step, into a great and powerful position, built on a rising scale of success. It is a perfect fusion of caution and courage, of defense and offense. It is a system that mathematically forces a speculator to have his smallest bets on his inevitable failures, and his largest bets on his rare but glorious successes. The 1% probe is the key to this entire process. It is the gatekeeper that separates the low probability guesses from the high probability campaigns. It is the safest mathematical way to start every winning trade because it is a system designed to ensure that you survive all the losing ones. It is the first and most important step in transforming speculation from a frantic emotional gamble into a calm, disciplined, and ultimately profitable business. This was the method that underpinned Livermore's greatest victories, and it remains the only true path for the speculator who is serious about his craft. To truly understand the mind of the man who mastered these principles, to witness the epic market battles where this very plan was put to the ultimate test, the essential chronicle remains Edwin Lefebvre's 1923 masterpiece, Reminiscences of a Stock Operator. This is not merely a book. It is a deep psychological portrait of a master at work, a narrative that gives life and context to every one of these timeless rules. For those committed to this study, a link to the edition featuring a unique, detailed chapter-by-chapter analysis by Max Davidson, an interpretation specifically designed to translate this century-old wisdom for the modern reader, is provided in the description below.